I think most of you are familiar with me, but if not, I'm Jackson Kaspar. I'm CPCNH's Director of Member Services, and I'll be moderating today's office hours. We also have Nick Gosling, who is our Communications Manager, who will be in the background helping to monitor things on that end. And with that, today's topic is the guide to understanding CPCNH's financials. And you can go ahead and advance to the next slide, please. For the agenda today, the speakers will be talking about the corporate structure, going through financial reserves, oversight and management, talking about some of the various financial reports that are presented to the board and publicly available, and then ending with some discussion about mission, strategy, and takeaways. And just as a reminder, as a public power agency, CPCNH has 68 municipal and county members and serves approximately 190,000 retail electric customers. Next slide, please. So for today's speakers, we have our treasurer, Kathleen Kelley, who under the bylaws oversees receivables, payables, accounting, investments, and submits regular financial reports to the board. And then we have our executive director, Henry Herndon, who under the joint powers agreement holds the chief executive officer duties and oversees administration, management, operations of staff, and service providers. So together they have shared responsibility for preparing the annual budget for approval by our board. And with that, I will turn it over to our speakers to take it away.
You're up first, Kathleen. Oh, wait, maybe am I up first? What's the next slide, Jackson?
Next slide, please.
Oh, I apologize.
You're up first, Henry.
Things. I'll jump in, and then Kathleen will get into some of the details of the reporting. But I'm just going to start. Did you want to say anything up front to Kathleen?
No, go right ahead. Talk about the corporate structure.
Right. So I'll talk about our corporate structure, Joint Powers Agency. This will be a refresher for some folks, but really our financial structure and management flows from our corporate structure and our joint powers agreement. Looking back to the JPA, the purpose of CPCNH is for the city and town members to establish an independent enterprise that is financially sustainable, mutually beneficial, and responsive to the local priorities of the members, and to have an organization that is well managed and overseen by the local elected officials and members of the public from the respective cities and towns to promote the common good, general welfare, and support local economic vitality and prosperity. So within our bylaws and our founding documents, we're member governed. Jackson mentioned the membership. The membership elects a board of up to 20 for oversight purposes, and all of the 68 member cities and towns may serve on our oversight committees, including the Finance Committee and the Audit Committee. The Finance Committee meets monthly, and its purpose is to advise the treasurer and the board on the investments, budget, and fiscal policy of CPCNH, and to receive monthly treasurer reports, track financial reserves, position and forecasts, and to deliberate on rates along with the risk management committee. And our bylaws also call for an independent audit and an audit committee to oversee the quality and integrity of our accounting and the independent annual financial audit. So just to draw our attention to a couple of other items from our JPA, there's clear language on fair and transparent cost allocation and cost sharing. So each member's customers should pay for costs associated with those customers, but not costs associated with other towns' customers. There are pathways for voluntary projects where cities and towns can enter into projects and develop local generation assets, for example. And then provisions for the costs and benefits of those projects being associated only with those participating members. There are provisions for municipal bonding authority, and as a governmental instrumentality, CPCNH is eligible for certain municipal financing opportunities, including issuance of revenue bonds. And then there are some liability shields for the member cities and towns where CPCNH's liabilities and debts are not are sort of non-recourse to the cities and towns other than what they have explicitly agreed to in our cost sharing agreement. So sort of a firewall liability protection. Also note that all of our books and records are open to inspection by members. So at any point in time, member reps or select boards or what have you are welcome and invited to reach out to inquire about CPCNH's financials broadly or as they relate to that specific members program. So some of the business considerations, and Kathleen will talk a little more about this. Cash flow management is really important for this type of organization due to the 45 to 60-day delay in receipt of cash deposits from the time of incurring costs for purchasing power supply. Risk management is something we focus on very closely at CPCNH with our risk management committee, being that we operate in this volatile wholesale energy market that's subject to changes. And yeah, managing risk and managing timing of cash are really key for our business success. So just to summarize, sort of a non-traditional business, but definitely operates like a commercial enterprise with, revenues and costs and expenses. So funded through the sale of electricity, low assets, small staff team, and currently reliant on consultants and other external parties for some of the operations. Next slide,
Okay,
please.
next slide. Thank you, Henry, for oversight of the corporate structure. It really makes a difference on how we do accounting within the organization. Can we get to the next slide, please? Great. So as Henry mentioned, we have cost sharing agreements with our members that require us to be very open and clear about how costs are reported by community, by member. And it talks about cost, where the cost and revenues for each member are allocated to the member so that not one member is harmed by another. And on the fiscal reserve policy, we have reserve policies set at a minimum of 30 days of operations, a target of 120 days. We really need about 180 days, but we can get the remaining days through a revolving cash flow loan as we progress. And the purposes of the financial reserves is to help us develop rate stability, to avoid extra expense like interest expense, to secure the 30 days of operations with a revolving loan, manage our risks, be able to position us to do projects with counterparties, and also to be able to be better buyers of energy on the open market, so we would have more options. Next slide, please. In the financial reporting, we actually talk about the finances in 3 or 4 different ways. We have our traditional QuickBooks online accounting, as any business would, where the accounts are established and reconciled to bank accounts. And the documentation for transactions would be like invoices from vendors and also bills to customers. But we also have a cash flow model, because cash flow is very important in this business, especially as Henry said, we are buying sometimes 60 days before we actually deliver the power to a customer, and then we have to wait another maybe month or so before we get paid for that energy. And then we also have a cost of service model, because again, the flow of information, the flow of invoices, we may get an invoice for today sometime in February or March of 2027. So we keep outside of QuickBooks a cost accounting of each month or flow month so that we can look at whether we charge the right rates for the energy provided that month. It's a great learning model for us. So in the cash flow and cost service model, we use a probabilistic financial model that's managed by Ascend Analytics, who is one of our larger consultants, more important consultants, who help us plan our hedging and plan how much energy we will be delivering. We also use inputs like the bank records and invoices from ISO New England. We use Bill.com and QuickBooks online accounting data, and we load our forecasts. We use the models to forecast our loads that we expect. And we keep track of our forecast, which changes by the week. We check our we set a budget at the rate setting process time every 6 months for the enterprise, the energy portion of our budget. And we check that to what we think will happen because things change in the energy market. As we know, there's a lot of volatility in the energy market right now with the costs of the war and the delays of the delivery of oil and gas. So we have a lot of volatility. So we have to keep track of what the forecast is. So we have a forecast model, we have the cost of service model, we have a cash flow model, and then we have the accounting. So we're keeping track of everything. And the staff and I do a lot of work to make sure that we're using the source of truth for each of these models so that we're reconcilable between all of the various models we're looking at. Okay, so we also have the delayed bills mostly relate to resettlements. So as a utility reconciles how much energy they delivered to customers, that goes through ISO New England, and we end up with a reconciliation or a resettlement invoice. We'll know what that invoice is mostly within 90 days of the end of the month, of the flow month. But then we might also receive some smaller bills later on during the year. Can we go to the next slide, please? So these are unaudited. We're in the process of completing an audit. Barry Dunn is our outside auditing firm. But it gives you a sense of where our expenses are. It's mostly in the energy hedging expenses. We try to buy our energy ahead when we know what the prices are so that we can fix and reduce the risk of providing that energy. We hedge before we set rates for that period. We have a renewable portfolio that we have to buy based on the number of megawatt hours that we deliver. And that cost and the volume of RECs that or renewable portfolio that we have to buy is determined sometime during the year, sometimes after the year. So we make our best estimate of what that's going to be. And then sometimes we have to adjust it in January or February of the following year. And we buy those RECs mostly in the following year. We have other costs associated with energy capacity, auxiliary, and then the energy that where you see the energy costs of 23 million, that is energy that is bought more closely to the day of service, the day of delivery by ISO New England. We can estimate how much is going to be drawn, but as you know, in January we had a big storm that wasn't expected. And so there was a difference between what we hedged and what we had to buy on the open market or rely on ISO New England to procure for us. So revenues are mostly the revenues come from the utilities collect our customer bills, and then send forms reconciling the amount of money they're sending to us and their customer receipts to Calpine, who does the reconciliation of our revenue and then passes that along to us or credits our accounts for that. Operating expenses are small, mostly our professional services that we hire out, like services from Calpine and Ascend and some of the other legal and accounting services. Salaries is our next biggest item. Interest expense has grown because we've had difficulty in 2025 with cash flow, as most of you know, but we can talk about that again. So let's go on to the next slide. Here is a statement of activity. It's what you would normally see as a P&L, profit and loss. It records the activity for the period, whatever the period is. This is January 1 through December 31st, 2025. We look at it in a very detailed way every month at the board level and in the finance committee, but this isn't a summary for you. The ISO settlements have been more than what we budgeted in 2025, mostly because of an additional market or a new market called the DAISY market. Day ahead, Henry, help me with this. Day ahead, something.
Ancillary Services Initiative. Yeah.
Great, great. Thank you. And capacity and the energy that's bought in addition to what we've already bought in hedges. So in 2027, the ISO is looking at reorganizing the capacity market. So we may see some surprises with that next year. And we know that, and we are planning for that. So you see here where the big components are: the hedge, 96 million, the costs from ISO New England, 51 million. And then RPS is our requirement based on the megawatts of how many, how much renewable energy credits we have to buy for the year, which is 12.6 million. And then expenditures, most of the operating expenses you see in 80/50 toward the end is interest expenses. And then our salary, taxes, and benefits are lower than what we had anticipated in 2025 because we've been delayed a little bit in doing the full hires. We now have Henry as the ED, and we're hoping to hire this year shortly the finance director and the director of power ops. So when we talk about net revenue, we're another word for it is net margin. Another word for it is the community reserves. So as those accumulate, that community reserve is shared among the members. And we record that in the CAB report that you see each, about every 3 months or so, we come up with, we reconcile the CAB report. Okay, so we're measuring here just a period in time. Let's go to the next slide. The next slide is a financial position. This is our wealth. This is our value to the members. This is what we have accumulated since we began just a few years ago. So you'll see accounts receivable looks very high with 29 million. And accounts payable is quite high with 19 or almost 20 million. This is as of December 31st, 2026. It's actually even higher now, but we'll talk about that in a minute. So we have bank accounts with River City Bank that are used to process our expenses and receive the revenues from the utilities and manage our reserves for the discretionary reserves collected for specific communities, as well as the joint reserves. Um, we have some accrued expenses. Most of that 15 million in accrued long-term expenses are now current expenses. That's the RECs that we had to buy in 2026 for 2025. And we buy those by July. So we'll spend 15 or actually 13 million before July buying RECs. And then when you look at retained earnings, that's the accumulation of earnings or net income since we began providing energy to communities in New Hampshire. And then net income for the period December 31st, 25 for the whole year was a minus 3 million and three. That could have been a lot worse had we not uh, done a lot of work over the last year to shore up our EPRM, our financial reporting, our budgeting process, and our cash management process. So we can go on. Again, this is a financial health, wealth value for members. Let's go on to the next. So some things that you'll notice as you look at our books from month to month, the AR and AP balance changes quite a bit because we before we set rates, we make a commitment to buy a certain amount of energy so that we know what the rate needs to be to cover our costs. We do have a lot of uncertainty with our forecasts, and it's been volatile this past year. We had a budget that may have not been developed in 2025 or for 2025 using probabilistic forecasts. And so we were caught surprised when resettlements came in much higher than expected, and when Daisy Market got reorganized, and when we had some storms where we had high energy usage in June because it was so hot. So the lower our reserves get, the less risk appetite we have. And we do more full hedging to provide more certainty so that we don't have the risk of loss. We've learned that lesson. We've done a good job this year, and we're beginning to climb out of the uncertainty that we faced at the beginning in quarter 1 and 2 of 2025. With healthy reserves, we can become a little bit more competitive and create more value for our customers. In liabilities, you'll see discretionary reserves. Towns can add an adder to their rate and create a reserve that they could use to address energy needs in their town. I know one town is using some of their reserves to do education in the community about how to save energy. We also have some investments in the project called Poverty Plains, and we have a couple others that we're working on, and that also shows up in that balance sheet. Okay, go on to the next. So this is where we wanted to kind of share with you what we look at. What are our key performance indicators at this moment? And some of them come from the cash and the cost of service model, and some of them come from QuickBooks that we watch. We watch the number of customers, and those have increased since we did a refresh in March. We stopped refreshing in 2025 to reduce the risks until we got a better handle on things. The difference between retail and wholesale megawatt hours are line losses. It's a measurement of how much power the utilities have put on the line for our customers versus what was billed. And we keep track of that. We also look at forward strip pricing. We do not speculate with energy purchases for our customers. We have to, though, keep on aware of what the cost in the day ahead market or in the future market is for energy so that we know when is a good time to buy. And if we need more energy, we can do some additional hedging if we anticipate a storm or a very hot week or period. We also look at what our COGS per wholesale megawatt hour are, cost of goods sold for wholesale megawatt hour, and our net margin for wholesale megawatt hour. And we've seen a lot of difference. This document here that you're looking at, the budget reflects what we thought we would get when we set the rates for the period UAP 7. That's a 6-month period. The current is what we're estimating and forecasting for through the end of UAP 7, where we will be. So you can see that we do have more customers than we anticipated because we didn't know for sure whether we were going to do the refresh in March, which we did. You can see the growth in retail and wholesale megawatt hours. Some of that was driven by new customers, but most of it was driven by storms at the end of January and early February. You can see that the forward price is coming down. This is typical for where we are in April. Prices tend to go higher in the winter when there's a lot of demand. And we're seeing a difference in our COGS, and mostly that is due to the daisy costs. So that's what we watch the hedge ratios. How are we doing? Did we buy enough power for the customers that we have? We are very concerned about rate competitiveness, but also we need to make sure that we cover the total cost for operating. Some of our competitors have had losses, but they have not accounted for them yet and are debating with the powers that be about how to recover those losses. So going on to the next. So with the cost model, the C-cost model, we also keep track going out into several years after this year, trying to see where we stand, how we can accumulate the reserves that we need. This $30 million dash line is our target. And we want it to be there within 5 years of operating, which would be 2028. Where we are today is at about $18 million we've borrowed from our Calpine, who is facilitating our debt right at the moment. And I guess that's probably the cash balance. We obviously don't have a negative cash balance. We just have more accounts payable than receivables at this point. So going on to the next one. This is the what we think we will have in reserves. Right now, we're at minus 6.5 million in terms of reserves. We have been much lower during the year in 25, but we were able to see some accumulation in the last half of 25 to recover some of the losses that were triggered by decisions made in December or January. And like I said, our goal is to get to 120 days of reserve plus have a cash flow loan of about another 30 days. And if we get to that point, then we can buy from different, more competitive, we can get more competitive rates on our energy that we buy through hedges. We can reduce the cost of borrowing. And And so we begin to bring a better value to our members. Do you want to go to the next slide? The thing to remember is that what we're doing is creating value for members. We are, yes, accumulating joint reserves, but we also are doing local programs like the Poverty Plains and offering communities the opportunities to do discretionary funds to accumulate funds for local projects, like Nashua is doing this education program now. We also are creating a more competitive landscape and a more possible local use of purchase of energy. We were able to procure some of our RECs locally this year and from some customers that, or some people in the communities that have solar, we've been able to offer to buy their RECs at a competitive price. We do project development, again, like Poverty Plains, where communities weren't able to work together. This was one that we were able to bring the local goals of several communities together and create something very positive. And that's what you see in the side picture there. And then we try to serve all of our members equitably. And that's a difficult challenge. We're not yet able to service solar customers, but we will at some point. Um, but each utility has a different cost of service. We have agreements with each utility called POR. It's a purchase of receivables. So they have purchased our bad debt. Um, we have really no right to be able to collect on the bad debt of customers who don't pay. They're the customer of the utility. So we've come to an agreement. I think it's 1.6%, and it might be less now, with different utilities on how bad debt is collected. But we really always have the members in mind. Do you want to go to the next slide? The governance of the organization will be changing a bit once we get fully staffed. Right now, we have a very operational board. I know I have been spending way more hours than I expected. But as we move forward, board of directors are looking at, do the rates cover our costs? Are the margins set appropriately to bring stability and to lower our price for members? Are we complying with investment policy, the financial policies, the accounting policies, the energy risk management policies? And then the staff, again, when we get the power ops and the finance person also in place, we'll be looking at, are there counterparty risks? Are there collateral calls? Are we complying with the hedge ratios? Have we bought enough energy for the next few months? And are there other strategies that we can be using? What is the weather doing? So our goals are the same. The board is looking at policy and budgets and whether we're doing what we say we will do for our members. And the staff is actually operating the organization. So rate stability is our primary goal and competitive. We hope to be competitive shortly. We want to meet our reserve targets. We want to be, well managing our risks. We want to diversify our credit support. We don't want to have accurate financial forecasts. And we want to be able to meet our cash flow requirements. We don't want any more oops, which is what we've had to deal with in 2025. So, and we want efficient operations. And we look at other CCAs for our targets on that. Henry, did you want to add anything to this?
I think that was very comprehensive, Kathleen. I don't
Okay,
have anything at the moment.
okay. All right. So the next slide, I think, is for questions and answers. And I happy to answer any questions, burning questions people have. Feel free. Nothing's beyond asking. This is a very unique market. So feel free to ask anything.
Great. Thanks so much, Kathleen and Henry. I'm not seeing any questions in the chat at the moment, but yeah, it's open Q&A. So folks, feel free to raise your hands and we can call on you to unmute.
When we talk about the cost of service, I'll just keep talking until somebody tells me not to. I think it's fascinating. I've never had experience in the energy market, but it is very fascinating how it has been organized, and the various ISO New England, PUC, Energy Department, the Office of Consumer Advocacy, all of that it plays into the decisions we make. And my role as treasurer is to try to make sure that we're providing the board with accurate reports, all balancing. I keep a close eye on the cost of service model. And I reconcile that to the QuickBooks model. The forecast at the beginning of the rate period is more important to me in terms of comparing our performance. But the forecast changes each month as the market changes.
Great. Thanks for that added context, Kathleen. There is a couple comments in the chat. The first is from Beth McGuinn with Canterbury. She was asking, what were the oops of 2025 that you referenced?
We
I'll
didn't. Okay, you can
Yeah,
go
I was just
ahead.
going to jump on this. But part of
Sure.
the answer is for those of you who are attending our annual membership meeting, we do have the results of an independent risk audit that's in the packet. That's public material that'll be presented on by the Energy Authority, who's an independent firm that we hired to conduct that analysis. So I encourage you to look at that. And then sort of the short answer is we have minimum hedge requirements. We have to hedge certain percentages of our portfolio and lock those costs up into fixed price contracts. Go in winter of 2024 to 2025. We deviated from that and had more exposure to the spot market, and the spot market ended up being quite expensive. So essentially, costs exceeded revenues as a result of that, and perhaps rates not totally covering all of our forecasted costs as well. That's perhaps the short answer, but would happily direct folks to a report that has a little bit more. It's actually quite digestible. It's maybe a 4-page report, but it's a good summary there. And I don't know if you want to add anything to that, Kathleen.
Yeah, I think that from an accounting standpoint, I think if we had been doing a better job of tracking all costs each month, including resettlements, including the accrual of RECs, including estimating what we thought we would have in total costs for the month or for the flow month, wasn't really accessible by anybody, staff or board, until July of this summer.
All right. Thank you. Moving on to a couple other comments from Carol with Hampton Falls. In the rare case of a town leaving CPCNH, what steps do we need to take with a money symbol?
Yeah, I'll jump in on this again. So under our cost sharing agreement, there's a provision for member exit or withdrawal from CPCNH, and there's sort of a few layers to that. On the one layer, there's a maximum 36 months term from receipt of notice of withdrawal. So that's the ceiling. So CPCNH can't really obligate a member beyond 36 months, but we are actively managing this portfolio, and it is advantageous for members to sometimes procure power out 12, 24, or 36 months into the future to be as competitive as possible. Within that 36 months, a member may leave early, And the requirement is just that none of that town's cost obligations can be shifted to another town through their departure. So there's a process either by which we've purchased an obligation on their behalf, a power contract. We would allow that to roll off or expire. Maybe that's a 6 or 12-month contract. We could also unwind that contract. We could essentially sell it back into the market at market prices and then apply that credit or debit to the balance of the town. And ultimately, I don't know that this is likely, but a town could deposit funds with CPCNH to cover any costs of early withdrawal. I think most likely the town would sort of get the minimum waiting period sometime between 6 months and 36 months, and then CPCNH, after ensuring there would be no cost shifting, could return those customers to the utility or to another supplier of the town's choosing.
Great. Moving on to the next comment from Charlie Smith. Notice on the financial position slide that the organization is solvent and a positive equity of 4.8 million. I was confused how a few slides later there was a liquidity issue with cash reserves. Can you explain that a little bit more?
I can take that one too if you want. In the winter, we have again to hedge in advance of the month, January, February, March, April, and so we're making a decision in November how much to hedge, and that all costs quite a bit in the winter. So it's seasonal that we will always have a higher need for cash in the winter versus the summer and spring months. There are a couple of months in the summer that get very hot and people use air conditioning that might put us over the estimated forecasted power load.
Yeah, and just to build on that a little bit, another way to think of this would just essentially it's negative margin in January and February. So if we have positive reserves at the end of December 2025, January was a particularly expensive month. And we won't get into all the details on this DAISY chart, but certain ISO forecasts exceeded certain ISO actuals exceeded forecasts by significant amounts for all suppliers, but the negative equity position in Q1 2026 is a result of seasonal negative margins in January and February.
We set one rate for the whole period, 6 months, but January, February, well, the 6 months of UAP 7 would be February, March. So those 2 months are more expensive to serve than the April, May months and June and July months.
Great. I am not seeing any other comments in the chat at this point. I'm keeping an eye out.
I just want to bring up one thing. Like at the end of March this March, our total equity for the organization is minus 7 million. Okay. There are some communities that joined CPCNH at the very beginning that had accumulated some positive balances in the margin that they accumulated. But towns like mine that joined in October 2025 have only seen negative balances. So if Randolph wanted to pull out right now, it's a very small town. We have a small balance that we would owe CPCNH so that none of the other members would be affected by our departure.
Yeah, and to build on that as well. So March reserve position negative 7 million. If you rewind 3 months, positive 4 million in December, heading into the winter. And then if you look through our forecast, we see maybe July in the range of 1 to 2 million in reserves. So, the organization experiences perhaps 15 million in revenue on a monthly basis, and with seasonal cost shifts or cost changes, that has an impact on the margin. So I think it's helpful to understand the kind of flow of reserve, maybe a seasonal draw in the wintertime, building of reserves through the shoulder months of the summer, maybe a slight draw in a high cost summer month, and then building again through the fall period. So yeah, just some more context around the way reserves evolve over time.
We have another question from Beth. She's asking, what are we seeing for individual opt-outs and how is that likely to impact overall finances, considering that these are coming in the winter when costs are high, maybe higher than income for customers during those months. So I guess I'm saying when there's a spike of opt-outs with a rate change in the winter, um, is that more of a problem because those customers are then not participating in the spring? I can take a first shot at this just to say that, we conducted a, fairly large refresh for the organization in March, and that's actually continuing with one town into April. And we're very conservative about those assumptions, and that's really boosted our customer volume because the majority of the attrition we've seen over the years is what we call natural attrition. It's from like housing turnover. And therefore, the organization had a refresh policy, conducted a refresh, and that really boosted the accounts and added a lot of accounts during a period of high margin. And that's sort of helped balance out some of the other opt-out activity we've seen as a result of rate changes. So
And
that's, yeah, I'm sure
and we're
others.
almost back to where we were in January. We did lose
Right.
customers in January or after January 2025 because our rate was higher. But we have now refreshed and we're almost back up to where we were in 2025 January.
There's a question. Bruce, I may want a little more context on this. You're saying, would Peterborough's inadvertent enrollment count against our reserve balance when eventually resolved?
I know, I think I know what Bruce is referring to, and Bruce, the answer is no, it will not.
Thanks for that, Henry.
Yes, thanks.
Okay, we still have about 10 minutes left in the session, so still opportunity for other comments and questions. I know it's a deep topic. Really appreciate Kathleen, all the time that you've put into educating our members on this. It's super important. So,
We really need members of the audit committee, which only meets twice a year. It needs to be an
true.
independent group that kind of receives the audit report. And we could all, that's a very light 2-hour commitment for the year. We could use some people on the finance committee if you're interested. So please don't hesitate to volunteer.
Yeah, thank you very much for mentioning that. Those are very good points. From Beth, this has been really helpful summary. Thanks for all the time that went into it, Kathleen. Agreed.
And
Okay.
you all can ask questions. You can send me an email. I think my contact is available. If anybody has any questions, I'm happy to answer them later.
Maybe everyone wants to get out in the sunshine.
Is it?
All right. Well, seeing none, maybe we can end a little bit early, but thank you all for your participation today. Thank you once again to our speakers, and we'll hope to see many, if not all of you, at our annual meeting, which again, as a reminder, is coming right up next Thursday, the 30th. So hope to see you in Concord for that. All right.
Thank you all for your time.
Take care all.
Thanks, everyone.